stock that has been on the up move over the last 6 months or year to date, for the matter of fact, and that is South Indian Bank. We have the management of the bank joining us right now. We have Mr. Murali Ramakrishnan, who's the MD and CEO at South Indian Bank, joining us this afternoon. A very good afternoon to you, sir. Thank you so much for joining us on ET Now. And let's talk about the quarter gone by. Your financials have improved. If you look at it on a quarter-on-quarter basis or year-on-year basis, your NIMs actually expanded pretty sharply when you compare it on a quarter-on-quarter basis. About over 70 basis points uptick coming in your NIMs on a quarter-on-quarter basis. Could you tell us what exactly has led to such an expansion in your NIMs, and do you think that this is the peak of the NIMs now?
Yeah, I think this is not work for this quarter alone. Actually, we've been doing a lot of activities over the last 2 years in really transforming the bank, and we have actually done quite a good amount of work. We have structured both in the liability side as well as on the asset side. And if you were to really look at on the liability side, the predominant focus of trimming down our bulk deposits, etc. That's a journey which we undertook about 2 years back. We've been sort of reeling our deposit base, and retail deposit base is growing for us. And that has led to the overall cost of funds, cost of deposits coming down. And we have been able to substantially improve our CASA, which used to be sub 25% about 2 years back, to as high as 34% now. And there is a continuous effort which is being put into improve CASA, and even amongst the CASA channels which are contributing to CASA growth, we are seeing good traction happening across all segments: retail, government, task, as well as ANR. So this is on the liability side. And the asset side, of course, we have been because of the rates which have been prevailing pretty low in the market for during the COVID period. We have started now the rates hardening with RBI improving on their repo rates, and which is clearly so now we are pricing to the risk more appropriately. That's helping us to reprice our assets, and that's also helping in a way to overall improve our overall NIM. So in effect, I would say that the mix of the portfolio now with more and more of though in overall numbers still they are very low, our unsecured is picking up now, and we are also able to reprice our SME and corporate loans much better, and we are able to continuously work on reducing our cost of funds. So all in all, it's helping us to improve the overall NIM. And so we were at about 2.6% about 2 years back. As I'm talking to, we are now close to 3% for the bank. And I'm hoping that we'll touch the milestone of at least 3.2, 3.3% in the coming quarters.
Okay, so 3.2, 3.3 in the coming quarters. That's the word coming in. Mr. Murali, I also wanted your take regarding the asset quality, because while the GNP ratio has been improving, it's still around that 5.7% mark. Going forward, what kind of improvement should we expect there? And if you can also talk to us about the ROA or the return on asset ratio, because it's improved considerably to 0.85% versus 0.46% on a quarter-on-quarter basis. Is this number sustainable, you think?
Sorry, your voice was breaking. I couldn't really hear you.
Sure. So I wanted your comment regarding the asset quality plus the return on asset ratio.
Yeah. The way we put it, as of Q2, we had a total portfolio of about 67,000 crores. If I were to really break that assets into what we onboarded from the time I took charge, which was October 2020, we have added close to 34,000 crores of new book, and that book is performing impeccably well, and we have a gross NPA of close to 0.02% in the new book which we have added. So this is almost 50% of my overall book. So with the new book not adding anything to my slippages, and with the old book continuing to be trimmed because of our improved collections and upgrade, etc., overall we are able to bring down the bring up the recovery and collection. Just to give you some numbers, we entered the year 21st March with the 600 crores of upgrade and recovery, and we ended the year March 22 with 1,500 crores of upgrade and recovery, which was almost 2.5 times of what we did the previous year. This year, as we are seeing traction as of Q2, we continue to see same level of performance as what we saw the last year. So on one side, with the new portfolio giving very less slippages, and with the old portfolio getting managed through improved recovery and collection, I'm expecting that overall portfolio quality is on the rise, and I'm expecting the overall credit cost also to trim down as we see. And obviously, that will also mean that lower and lower provisioning as we go forward. In terms of slippages for the full year, I had given a guidance of 1,600 crores for the full year. As of Q2 end, we are slightly above our halfway number, but I am fairly sure that in Q3 and Q4 we'll be able to bring it down within the overall guidance which I've given, which is 1,600 crores. If you were to really look at the breakup of 1,600 crores, it was 25% from my restructured book. I had a restructured book of 2,400 crores as of Q1 end, and I was hoping that 25% of that will slip into NPA over the year. And so 600 crores coming from there and 1,000 crores coming from existing book. I was looking at 1,600 crores of guidance for the full year. I'm happy to say that we will probably be having some positive surprises by the end the year. As far as ROA is concerned, we were at less than 0.1% when I took charge, and there has been a continuous effort in improving ROA. So as I'm talking to, we are at about range of 0.6% for the book as a whole, and our obviously milestone is to reach 1% over the next several quarters. And as far as ROE is concerned, we were at about less than, again, very, very low ROE to start with. And as I'm talking to, we are now at about closer to say double digit now, 10% kind of ROE now, which we used to be below 1% quite some time back. So on all the profitability parameters, whether it's NIM or PAT or ROE or ROE, and as well as the portfolio quality, we are improving continuously. And PCR, which is again another indicator, there again, what we used to have was PCR excluding write-off, which used to be at about 32% level. As I'm talking to, we are at about 57% level, including write-off, which we used to be at about 60%. We are now at about 72% as of Q2 end. So in all the profitability and quality parameters, we see we have shown good traction in the last few quarters, and I'm sure that trend will continue as we go along.
Absolutely, and on that optimistic note, we leave it there, Mr. Ramakrishnan. Thank you so much for joining us on the show and talking what